Many investors rely on dividend aristocrats and kings because their long track records of payout raises signal safety. Aristocrats have raised their dividends for at least 25 straight years, and kings have done it for over 50. These are dependable businesses, the kind people want to trust for steady income, especially if the goal is to live off dividends and avoid selling shares in retirement. The challenge is that most of them yield less than 3%. Great for stability, but not enough income on its own. So here's the question. Can you build a safe 5% yielding portfolio using only dividend aristocrats and kings? Let's find out. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. I built a sample portfolio using our website, Simply Safe Dividends. If you want to analyze your own holdings the same way with dividend safety scores, payout ratios, income forecasts, we offer a free trial with no credit card required. There's a link in the description below if you want to check it out. All right, here's our 5% aristocrats and kings portfolio. It has a $100,000 balance, throws off about $5,000 of dividends each year, and has a 4.97% dividend yield. Now, there's less than 100 aristocrats and kings, so I wasn't sure we'd be able to hit our income target while keeping the portfolio diversified, but I was able to get the job done with 20 stocks. They're equal weighted, each is 5% of the portfolio's value. And as we go down the holdings list here, you'll see a lot of familiar names like Clorox, Chevron, Federal Realty, a retail REIT, Hormel Foods, Kimberly-Clark, Altria, Realty Income, PepsiCo, Stanley Black & Decker, Target, T. Rowe Price, ExxonMobil. So a lot of really popular stocks that are common holdings in dividend growth portfolios. The highest yielding stock on the list is Altria with a 7.4% yield. Pretty quickly drops down to our 5% average yield target. And some of these stocks are just simply out of favor. Their yields are relatively high compared to their long-term norm, which really created the opportunity to make this high-yield aristocrats and kings portfolio. Now, these types of stocks are really popular because they've been so reliable for so long. You can see these dividend growth streaks span decades. We have a handful that are close to 60 consecutive years of dividend increases. The shortest streaks are pretty much all 30 plus years as well. So all manner of economic environments these companies have managed through conservatively and kept their dividends growing, which if you want reliable rising income in retirement, this is a good place to hunt. We also see their quality reflected here with their credit ratings. So we have a few, Exxon and Chevron, the two oil giants with AA- credit ratings, but all of them are investment grade status and typically multiple notches above junk grade. So this reflects their disciplined use of debt, which helps those streaks stay alive. Another point I'll highlight here is a metric we have called recession return. I'm going to add it to our holdings table and move it further up the list so we can see it more easily. But this shows you how a stock did during the financial crisis when the S&P 500 lost 55% from 07 to 09. And we can see a lot of these companies did much better. Hormel was only off 15%. Shares of Altria were down 20%, Clorox 23%, ExxonMobil 28%. So many of these companies significantly outperformed the S&P 500. Yes, it would have been better to own treasury bonds, but for owning equities, these companies' relative performance is quite impressive and defensive in nature. So let's take a look at some of the portfolio reports. Starting with dividend safety, we're trying to look at how risky this income stream is over a full economic cycle. And we do that by applying our dividend safety scores. If you're unfamiliar with our ratings, our scores range from 0 to 100. We recommend that conservative investors stick with companies that maintain safe and very safe dividend safety scores. We've been doing this since 2015. We've seen around 900 cuts come in real time. And investors who did stick with those companies that kept their safe and very safe ratings would have avoided 97% of the cuts that have taken place. We have a real-time track record on our site you can check out to learn more about all those cuts if you'd like to. From that lens, this portfolio looks decent. 70% of the income is coming from companies that do have safe and very safe dividend safety scores. Of the 5 that do not, they're in our borderline safe bucket, which we expect at least 2/3 of companies with these ratings to maintain their dividends over a full economic cycle. I don't see any big near-term concerns here. I don't see any Walgreens or 3Ms that are in this portfolio I made. Those are both fallen aristocrats that cut their dividends. So if the income is safe, we can look at this income calendar and feel pretty good about the income that's flowing in each month. Here's how the dividends shake out over the full course of a year. It's nice to have this payout schedule that's constantly up to date as payouts change. We can see the next 30-day view here. Our next couple payments are coming in Wednesday and then next week on Monday from Target and a water utility, H2O America. But the problem with this portfolio is really growth. So you're getting the high yield, but That's in large part because the growth has just decelerated quite a bit. This dividend growth report is showing the portfolio's income, which you would have received all organic, so we're not reinvesting dividends. This is just what the portfolio companies were delivering with their own dividends as they increased them throughout the years. And we can see the last decade was decent, 5.6% annual growth, but that slowed to 4% the last 5 years, and it's tracking to under 3% dividend growth this year. So you're not getting a whole lot of growth from that 5% starting yield. We're seeing this across many companies in the portfolio. If I open up the news feed here, we see that Hormel increased its dividend this morning, but by less than 1%. That was its 60th straight increase, but it's not really doing a whole lot to move the income we're getting from the stock. By the way, if you do maintain your portfolio on our site, you get these email alerts when companies change their dividends, so you're never surprised with how your income is changing, and it's nice to stay in the know with what's happening. But if we scroll down, we can see, let's see, I'll find another change here. Amcor, 2% raise earlier in November. We also send out research if we ever change a company's dividend safety score. So here's a note we published on Kimberly-Clark after it announced it was acquiring Kenvue. We downgraded the dividend safety score. It stayed in our safe bucket, but bottom line is you can see that these raises are not very significant. And that's in part because a lot of these companies are dealing with the same headwinds. If we look at the diversification report, we can see that 40% of the portfolio is in consumer staples. There's a couple tobacco names in here, but for the most part, companies like Target, Clorox, Hormel, Kimberly-Clark, PepsiCo are exposed to consumers that are increasingly just feeling tapped out. They're spending less on name brand products in favor of private label, and they're just being a lot more selective as they shop. So many of these staple companies have seen some earnings pressure over the past year, and they've seen their growth slow down quite a bit. That's pushed some of their payout ratios a little bit higher, and all caused their dividend growth to slow down quite a bit. So this portfolio is kind of a big contrarian bet on consumer staples bouncing back. Otherwise, it's spread out across financials, real estate, utilities, and energy, each around 10 to 15% of the portfolio. But more concentrated by sector than I would personally desire, especially in staples where the long-term growth rate is just not great. It's kind of anchored by America's population growth being rather low as well. From an income perspective, we equal weighted the portfolio by market value, which also kind of helps spread out the dividends. Altria is the biggest income source at 7.5% of our portfolio's total dividends. So no crazy concentration here. It's pretty well spread out in case any of these companies would fall on unexpected hard times. One of the more interesting parts of the portfolio is valuation. So I mentioned earlier that a lot of these stocks have dividend yields well above their long-term norms and PE ratios that are well below their 5-year averages. This reflects a big slowdown in growth for a lot of these staples companies, which make up nearly half of the portfolio. I'll show you Pepsi as an example here, pulling up the company's stock page on our site. So during the pandemic, demand went nuts for companies like Pepsi that were serving housebound consumers that were buying more groceries. Pepsi was able to push through big price hikes, and their sales growth jumped a lot compared to the usual pace for the company. But that tailwind has now turned into a headwind. Growth has pretty much evaporated or even gone negative for some of these companies. Pepsi's earnings were down 2% this past year. Consumers are feeling tapped out. They're opting for cheaper private label brands, and they're also eating healthier as well. That's part of it. But a lot of it is just this cumulative effect of inflation causing consumers to be a lot more selective with what they're buying. And that growth slowdown has pushed up the payout ratios of a lot of these staples and slowed down their dividend growth, which we saw earlier. Pepsi hiked by 5% last February. I would expect a smaller raise this upcoming February in a couple of months as it works through some of these headwinds. And this valuation chart we have shows you the price you would expect Pepsi shares to trade at in blue if shares were within 10% above or below their 5-year average P ratio. It's been a pretty good proxy of Pepsi's fair value over time, but the stock has been pretty stubbornly trading below that expected price band, even with earnings estimates ticking up recently. The P ratio stands at just 17 times, well below the 5-year average of 23. So if Pepsi and some of these other staples can stabilize their businesses, return to profitable growth, and kind of address some of the market's concerns there, these stocks could be set for a pretty nice rebound as earnings and multiples both improve. But will that actually happen? It's hard to say right now. The current headwinds feel like they're going to be in place for a good period of time. But fortunately, most of these companies generate very predictable cash flow and maintain pretty good balance sheets to kind of hide out during this tough stretch for the industry while keeping safe and moderately growing dividends. Overall, this portfolio, it's more interesting than I expected it to be. It's just ultimately for me a little bit too concentrated in consumer staples. I'd like to see better growth from a dividend portfolio like this, even one that targets a somewhat higher yield. I think investors would be perhaps better served by exploring a little bit beyond the aristocrats and kings. Using our screener here, for example, I put it in a screen looking for 4% plus yields, dividend growth of at least 3%, growth streaks of 10 plus years, so a little shorter than kings and aristocrats, but still earning safe and very safe dividend safety scores and looking under or reasonably valued. And here's 20 matches right out of the bat. Very few of these are aristocrats and kings, and some of them have pretty strong dividend growth. So it's a big pool out there to fish in for dividend growth stocks. Lots of different ways to build a portfolio. But I hope this video helped give you some new ideas, even within the aristocrats and kings bucket. If you enjoyed it and want to have this type of analysis for your own portfolio, I'll leave a link to Simply Safe Dividends free trial below. Again, no credit card required or anything like that. Well, thank you for watching to the end, and I hope to catch you next time.